Welcome back everyone to part 3 of the One Setup for Life series. In this one, we're going to be going into institutional order flow. You know the model, you know where the model forms in relation to the 9:30 opening price, and how to even frame what liquidity the market's going to run to. Now, how do you have confidence and trust that the market's going to continue delivering to your drawn liquidity, or is it going to reverse and the move not going to continue in your direction? That's determined through institutional order flow. Let's get into it. If you can read order flow, you'll never guess again whether your trade will deliver or reverse. This removes all the guesswork. It's black and white. Either institutional order flow is bullish, it's bearish, or it's 50-50, and you shouldn't touch the market at all. Institutional order flow is what separates emotional traders from those who execute with conviction. Conviction comes from confidence in knowing what you're doing and why you're doing it. If you're emotional, if you're nervous, if you're anxious, if you're uncertain for every trade, it's because you still don't have conviction in what you're doing, and hopefully this series will solve that for you. By the end of this, you'll know how to read order flow, to hold the target, and also recognize when market internals are shifting and the market's not likely to continue in the underlying direction that you're looking for. No indicators, no volume profile, and no level 2. Stuff is all trash. The market is not delivering based off those things. If you're making money with it, more power to you. It's not why the market is moving. I'm going to show you exactly why it's moving and how you can use it to frame setups, know why you're holding, and again, trust holding to target, not close too early, not add to losers, do things that losing traders are doing. Everything you need is in the candle's open, high, low, and close, or in other words, in the candlestick time-based chart. Anything outside of that, any level 2, volume profile, MACD indicators, it's all nonsense. Everything that you need is in the chart. Most traders panic because they can't read order flow. And when you can't read order flow, you don't know what you're looking at. What do you end up doing? You look at the P&L, you watch the money fluctuate up and down, you're a nervous wreck, and you don't understand why. But what you should be focused on is the candlesticks. And is the candlesticks continuously painting in your favor, or is it giving you warning signs that the market might not be moving in the direction or might not continue in the direction that you're expecting? They either close too early, hold too long, or add when the market is reversing. Closing too early means you don't have confidence in the setup and what you're looking for, and that is linked to order flow. Holding trades too long is because you're not able to identify the warning signs that the market's actually changing direction. And if you're adding to losers or averaging down into a losing trade, I don't know what to tell you. Order flow will help you solve that. They've never learned to read what the chart is actually saying. So if you don't understand what the chart is telling you, you're going to be anxious, you're going to be concerned, you're not going to know what to do when you get into a trade, and you're just going to be an emotional trader. It's very easy to get on the other side, but you have to understand what you're looking for in the price action. Institutional order flow shows the market's true direction, either bullish or bearish. And if you understand how to read order flow, it's very easy to see if a market is bearish or if a market is bullish. As price action traders, everything we need is visible in the chart. Signature here, market trading up into an up-close candle. Market retraces here into this gap, hits it, sells off. Market trades down into a fair value gap here, rallies, retraces, clears out the low, rejects strongly. Market drops down into this down close candle. That's a bullish order block. And it's all shown in the price action as to how you should be reading the institutional order flow so that you know what direction you should be focused on. The market communicates its next move through price action. ICT created the language of smart money concepts that we now use. And you can see that institutional order flow is the key to understanding whether a market's going to continue, reverse, or it's not clear and it's 50-50, which is also very good information to have. Bullish institutional order flow. When institutional order flow is bullish, you're going to see very specific signatures each time. Number 1, lows are rejected. So we see here, this low traded below, strong rejection higher. This low here taken out, strong rejection higher. This low here, which you may not see it as a low on this time frame, but what is it? It's a fair value gap. The fair value gap pattern in a lower time frame is a liquidity pool. That's why whenever the market drops into a fair value gap, it quickly rallies away, because on a lower time frame that you may not see, there is a swing low here that the market's dropping down to accumulate those orders. And then we see market drops down below the low, quickly rejects higher. Swing low here, market drops down, quickly rejects higher. Exactly what you want to see when institutional order flow is bullish. And then there's something else that you could do with these swing lows that take out liquidity, and that's as it relates to market structure, intermediate term highs, intermediate term lows. And I'll probably get into that in another teaching if you guys want to learn about market structure. Highs are displaced through. So lows are rejected in bullish order flow, but highs will be displaced through. So you see this high here, displaces through it like it's not there. This high here easily trades through it. This high here easily trades through it. This high here ran through. This high here displaced through. the market will have no trouble getting above old highs, and it'll actually seek those old highs when institutional order flow is bullish. Imbalances support price. Every inefficiency will support price higher when the market is bullish. So you see the market drops down into a gap, rallies, inefficiency here, trades down into it, rallies, gap here, trades down into it. Yes, the wicks color outside of the lines a little bit, but you see the bodies respecting it, and then the market rallies. Down closed candles will support price in bullish institutional order flow. So you see down closed candle, market opens, drops down, hits the high of it. That's a bullish order block. Market rallies. Down closed candle works inside of it, but still uses it as support, rallies. Down closed candle, market accumulates inside of it. New leg higher. Down closed candles, trades above it, uses it as support, rallies. Down closed candle, drops down into it. New price leg higher. You can trust the move will continue as long as down closed candles continue to support price. Intermediate term lows are created with several criteria. The one we're going to be covering here is whenever there's a stop run. So this low here does what? Takes out the stops here. This low should never be revisited. This low here takes out this low. It should never be revisited. This low here trades into a fair value gap and takes out this low here. You never want to see this low taken out. And then we also have an intermediate term low here with this low sweeping below this one. And that level should never be traded below. So intermediate term lows, you never want to see them violated when institutional order flow and now market structure is bullish. Now for bearish institutional order flow, you're going to see highs rejected. So you see swing high here, market trades above it, strong rejection with an imbalance. High here, market trades above it, strong rejection lower. Highs here, market trades above it, strong rejection lower. We see the market trades higher here, short-term high, clears it, strong breakdown. Short-term high here, market clears it, strong breakdown. So for every single high, the market's going to have a very hard time getting above it, and it's just going to go above that high for the express purpose of engaging the liquidity. And then the market will continue in the underlying direction. The reason that works is because retail traders who don't really understand what they're doing, what do the books tell them to do? Put your stop at the most recent high. So the market will do what? If they put their stop at the most recent high, market's going to stop them out. Smart money assumes that position, and then the market resumes in the underlying direction. Lows will be displaced through. Swing low here, displacement. Swing low here, strong run through it. This low here lays a body over it in a hurry to get below it. And then this low here, you see a really strong move through that. So you're going to see displacements through lows when institutional order flow is bearish. Imbalances act as resistance. So you see a fair value gap here, trades up into it once, twice, real support and resistance here, breaks down, imbalance, trades up into it, resistance, sells off, imbalance here, hits it once, hits it twice, and continues to sell off when institutional order flow is heavy or it's weak. Up close candles act as resistance. Up close candle here, trades up into it, sells off. This up close candle here, the market trades back up into it, sells off. Up close candles here, market works inside that level. And then you can see of the highest up close candles here, you can see the market trades up into it here once, twice, sells off, and you can see up close candles acting as real resistance when the market is bearish. Intermediate term highs should not be violated. High here takes out this high. So because this high took out the liquidity here, this now becomes a significant high in our analysis. This high here takes out this swing high here. Again, classifying it as an intermediate term high. Market breaks down, retracement into this high here. That's a stop run. Also creating an intermediate term high, which again, you never want to see them violated for order flow and for market structure to remain bearish. The market is either in a buy or a sell program, constantly seeking liquidity and inefficiency above or below price. What does that mean? A sell program means the market is going to be offered lower and it's seeking liquidity or inefficiencies below market price. A buy program means the market is bullish and it's seeking liquidity or inefficiencies above market price. The only two things the market's doing. If it's not doing that, it's consolidating and you're not going to make money there anyway. So if price rejects highs and holds below imbalances, order flow is bearish. So you see high here, trade above it, rejects it. High here, trades above it, rejects it. High, trades above it, rejects it. And then you see every single imbalance will hold if institutional order flow is bearish. Vice versa, if institutional order flow is bullish or we're in a buy program, if price rejects lows and holds above imbalances, you can trust that order flow is bullish. So we have this low here, takes it out, strong rejection higher. Imbalance can't even come into it. That's what you want to see. So ideally, it'll use it as support. But in the best case scenario, it won't even be able to fill it in. Drops down, takes out the low, strong rejection higher. Drops down, imbalance. Yeah, the wick color is outside the lines a little bit, but look at the bodies there. Market rallies, drops, imbalance, and a low, strong rejection higher. So you're going to see the market drop below old lows, have a very hard time making ground below it, but it's dropping there for the express purpose of accumulating the sell stops. At Smart Money Traders, we forecast direction, then we confirm it candle by candle. So we're predicting price, we're forecasting where the market's likely to go, and then we're able to confirm it candle by candle in the institutional order flow, and it's going to tell you everything you need to know. Take all the other gimmicks off your charts, it's making you clueless. If you look at price like this, everything becomes simplified. So every liquidity run creates a new reference point. When liquidity is taken, you want to mark that as an intermediate term high or an intermediate term low. So for example, here we see this high here takes out this high. So we have a higher high here than this one. So this high is taking out the liquidity and then we break. This becomes an intermediate term high in our analysis. However, when we get above that intermediate term high, market internals are shifting. So as long as that level holds, institutional order flow bearish remains intact. Once violated, order flow has shifted. So if you start seeing the market take out intermediate term highs, that's the surest indication that institutional order flow and market structure is likely to be bullish. Then you can see once that intermediate term high is broken here, we then get a subsequent rally. Now looking at a bearish example here, we have an intermediate term low because this low takes out liquidity here. Once that low is broken to the downside, that is no longer bullish and it's telling you the market is shifting and rotating to the other side. Institutional order flow gives the confirmation behind your entries. So I'm going to be teaching entries and stop placement on the next one. But before you understand that, you have to understand why would you get into a market to begin with? Where are you going to get in? Why are you going to get in? And then how are you going to trust that the market will continue to deliver once you've taken that entry? That's why I'm teaching institutional order flow first. It verifies that the market is delivering in your direction, right? So if you're taking a long setup, 930 drops, sell stops taken, we can reasonably expect the market to attack the buy side here. And then you can trust that the market will continue delivering as long as you get these very specific signatures in the institutional order flow. It's what allows you to hold confidently to target and also recognize when the move is complete, right? When the move is no longer likely to continue delivering in your direction. So if you take an entry here inside this gap or inside this down close candle, which we now know should do what? Support price higher. Well, how do you trust that it's going to get from your entry to your target here? The way you trust it is through institutional order flow. So gap, we trade down into it and a down close candle here. Does it support price higher? Absolutely. We now have what here? Another down close candle. We trade down into it. Does it support price? Yes. We create a new inefficiency here. Doesn't even come back down into it. That's exactly what you want to see. And then the market rallies and smokes the buy stops above the 930 open. The market communicates its next move through price action. So everything that you need to know from a market standpoint in terms of draw and liquidity, what target is the market going to reach for, it's all confirmed through price action. Let's look at how institutional order flow confirms the trade setup in every one setup for life. Every single trade that you're going to see me taking with this model will have these same basic components of institutional order flow behind them. And this is what allows me to hold the trade or know when to abort because the market's no longer likely to deliver in the direction I'm looking for. Example number one, as always, start with the 930 open, look left, where's your liquidity? Sell side here in the pre-market, and then pre-market sell side here. We have buy side here above in the form of these smooth, relatively equal highs. Whenever you start seeing equal highs like this, you should start salivating because your next meal is about to be served to you piping hot. At 930, we see the market does what? It drops into sell side here and here. So we can reasonably expect the market to do what? Want to seek the buy stops above. Well, what allows us to trust that the market will continuously deliver in the direction that we're looking for? Well, let's go to step one. Are lows being rejected? Absolutely. Market drops down here, takes out this low, strong rejection higher. This is a fair value gap here, but as I taught, a fair value gap on a lower time frame is going to be a liquidity pool. So we see the market drops down into here, hits the fair value gap, and hits the low on a lower time frame, strong rejection higher, into the buy side liquidity. So number one, check. We now want to see highs being displaced through. Swing high here, huge displacement through it. Swing high here, displacement through it. This high here has no trouble getting above it. This high here easily runs through it, and this high here as well, which is exactly what you want to see in a buy program or when institutional order flow is bullish. Every imbalance will support price for step three. Imbalance trades into it once, hits it twice, but does what? Leaves it open. Exactly what you want to see. This one here is a breakaway gap. For those of you guys who have been with me a little longer, why is this a breakaway gap? Because it's at 25% of the expected price run. From here to here, this is around 25 to 30%. You never want to see these fill in. So this isn't even a factor for an entry because the market's going to leave it open. Imbalance here, the market trades into it. Dylan, that tiny imbalance, the market's using that? Look at the bodies. You tell me. Hits it, rallies, imbalance, trades into it, uses it support, rallies, imbalance, hits it, support, all the way into the buy side liquidity. Easy money. And then here's the breakaway gap signature. Again, you never want to see those fill. because it's going to give you confirmation that the market will deliver to your ultimate drawn liquidity. And then we can see here, every down close candle supports price. Down close hits it, rallies. This down close here, you see we trade above, drop back down into it. That's an entry, market rallies. Down close candle here, works inside of it, leaves it, comes back down into it, uses it as support. 2 down close candles here, that's a bullish order block, drops down into it, rallies. This down close candle here, you can see the body's perfectly turning there. Every down close candle supporting price to the drawn liquidity. And then lastly, intermediate term lows. This is an intermediate term low because this low takes out sell stops here, and also because there's a short-term low here and a short-term low here. In between 2 short-term lows is an intermediate term low. This here is also an intermediate term low because it fills this imbalance, and because on this run higher, it creates a fair value gap. So any swing low that's created with an imbalance, that low always becomes an intermediate term low, and you never want to see it violated, and you see the market remains bullish. There's a lot more to market structure with short-term highs, intermediate term, long-term highs and lows, classifications. So that's very intricate, very detailed for me to teach here. If you guys would be interested in more insight on market structure, let me know down below, and that's something I can make a video for in the future. All right, going into example number 2, let's look at a bearish example here. So as always, we start with the 930 open. Where's the liquidity? Who are they going to gun for? We have buy stops here, but also these equal highs here. Just wanted to anchor it to this one because it's the highest one. So at 930, they run the buy side first. Where would we logically expect the market to trade to next? Sell stops. And again, when you have equal highs and lows like this, you should start getting very excited, knowing that the market's going to want to trade down into that level and that you have an easy setup likely to form right into retail's stop loss. Equal lows, expediently spanks their ass. 930, market runs higher, clears out this high here, and then we can trust that the market's going to get into the sell side. But now, how do we trust it's going to get there? I take the entries, Dylan. I look at the P&L. I'm not able to hold the trades. This is exactly what you need to do. Lows should be displaced down through. Low here, strong displacement through it. Low here, strong displacement down through it. Low here, strong break down through it, all the way into the sell side liquidity. We see here, imbalances should act as resistance. So this imbalance here, this is an inversion fair value gap. So because it was created as a buy side imbalance, sell side inefficiency, or an up close fair value gap, when the market's bearish, it'll change its role. So you see how we get down below it, we close below it here. That'll change its role to an inversion fair value gap. So let's say you were bullish, but now you learn how to read order flow. So what'd the market do here? It traded below a fair value gap and this down close candle. What's that telling you now? It's not bullish, it's bearish, it'll reverse its role. Fair value gap here. Market broke down, trades up into it. That was my entry on this trade here. Both of these examples I did trade, by the way, so this is stuff I'm really making money on, which not most educators are doing. So fair value gap here, market trades up into it. That's a short. Why would you trust that short? Because imbalances will act as resistance when the market is bearish. You see the market breaks down, trades up into it once more, respects it, continues to sell off. Up close candles acting as resistance. So 3 up close candles here, we break below it, trades up into it, resistance, sells off. 3 consecutive up close candles here. Market leaves it, comes back up into it, but respects the up close candles here. And then you can see this opening price here. Close below it, trades up into it. That's a bearish order block, and then dives into sell. Intermediate term highs, or in other words, highs that have taken liquidity should not be violated. So this high here takes out this high, strong breakdown. This high here takes out this high, strong breakdown. And then going back to step 1, every time the market runs liquidity, what's it doing? It's rejecting the highs. Highs traded above, strong rejection. Highs traded above here, strong rejection. Exactly what you want to see for bearish institutional order flow and market structure. This removes the guesswork and makes reading price simple. This is exactly how you want your trading to be. I know you hear a lot of things like ICP is complicated, he overcomplicates it. That's only the case if you have a TikTok mindset. If you're actually here to learn and take this serious and be a professional in these markets, it's not that complicated. You do got to roll your sleeves up and study so that you can learn how to do this yourself. When you can read order flow, you stop reacting and start anticipating. Most retail traders are reacting to price. They see it break out, they want to chase it. And from what you're seeing with this model, that's the worst time to sell. If equal lows are broken down below, that's when smart money traders are getting out of their position. And that's when retail is trying to jump in and sell it short, or they have their stop loss there. Why? Because they're reacting to price. They're not predicting anything. 90% of traders are gambling their ass off. The top 10% learn to read the market and eliminate the uncertainty. Now, when I say eliminate the uncertainty, that does not mean 100%, but it's confidence in what you're doing, why you're doing it, and now you know how to put yourself in the top 5%, which is precision, knowing what you're looking for, why you're looking for it, how you should trust it, And those are the things that are going to separate you from the 90% that are just gambling to the few percent of traders that know what they're doing and are in here hunting setups and taking something home every single month, finishing it profitable. And if you want to see what it looks like to trade like a pro, join our free Discord where you'll be able to see clips of me live trading with my mentorship group every single week, showing how it's done, not just on the left side of the chart like 90% of your other gurus are, but actually on the right edge of the chart, showing you how it's applied candle by candle, really doing what I'm teaching. Hope this one was insightful. See you guys in the next one.